Okay, so I'm gonna have a look at the market. It's April 3rd. It's a Friday. It's Good Friday, so we have this off of work. We have earnings coming up in about 3 weeks for all of the major companies here. I don't know why this isn't showing. Oh, so that's going to be Microsoft is April 29th. Where's Netflix? I think Netflix is the week prior. 4/16. So that'll be 2 weeks from now. So Netflix will be in 2 weeks, and then Microsoft, Facebook, Google, Amazon, Apple, Tesla, they're all going to come at the end of the month, the last week of April, and then Nvidia will go after all of those in May, the end of May, May 20th. But earnings is coming up, so we can look at this and see what's going on with them. Apple had dropped down. I was looking at this as like a when type of opportunity at the beginning of the year, and I had said that it'll probably happen around June. But it's kind of happening now. It's low, it's buyable, but there's other good buyable options, so I'm not really looking too closely at Apple right now. Amazon still looks good from the previous weeks, the previous video I had said. So we have really good buying here on Amazon. This line currently is about 212. So anything under here, which has been, how many weeks is that? 1, 2, 3, 4, 5, 6. Is that 8? 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks. So we've had 9 weeks to buy Amazon. Google had gotten sued by somebody for kids addicted to social media, and Google owns YouTube. So Google had gotten sued and they dropped down, but the drop wasn't significant or large enough to warrant any buying on it. Still looking for it to come down for a good buying opportunity somewhere at least like 265 or below, and this is the when that I'm looking for here. So maybe down to 230 and then anywhere in here in the near future, potentially. Facebook had a large drop because Facebook was also part of that getting sued by somebody for kids being addicted to social media. And the big ones were YouTube and Facebook, which is going to be Google and Meta. But there was an extra week here of really good buying. Now we're still at 575, so that's still a really good buy. But this was kind of just a blessing here, and I took that right away. But I hadn't been buying once we came up above, I think it was 650 or 675, because my average was so low that I didn't want to continue buying it after I'd already accumulated a handful of shares. But this one I couldn't turn down, so I bought this on that previous Friday when it had that large drop on it. The big ones that I'm looking at are Amazon and Microsoft right now, to acquire shares going into earnings. And Microsoft is obviously the major one here, where on previous earnings it had dropped down, and I had suggested buying this because we already had a bunch of Facebook and we already had a bunch of Netflix, that it was then time to buy Microsoft and to buy Amazon. And Microsoft continues to fall, and so these prices just continue to get better and better, and I'll just keep buying this all the way into earnings before we figure out who does well and who does bad on earnings, and we reset the charts and decide what we're going to buy. But Microsoft is a massive buy here, so I'm jumping all over this. Nvidia had touched my 165. It had touched my 165 maybe Wednesday or Thursday, which is this look that I was looking for back in November, December. And so it finally got into this when type of area where, if we say this tells us here it wants to come down, and then the when happened here, and this tells us it wants to come down, and then the when happened here. And so these are good prices on Nvidia, and if somebody wanted to buy them, I wouldn't be that opposed to buying Nvidia here at 177 or 180. Now the difference between where I didn't want to buy it here and where I do want to buy it here is that, what is that, August? So August, September, October of last year's $175 to $180 price on Nvidia isn't the same as 6 months later's 170 on Nvidia. This 170 is much more promising and much more interesting to get involved in than this one was, because this is high on the chart and this is now low on the chart. The pricing is the same, but the situation is different. The company is still the same company. It still continues to grow and it still continues to make money. And its future is still looking just as promising as it was 6 months ago. The difference is that 170 here is now lower on the chart than up here where it was time to sell it. So, if somebody wanted to buy Nvidia here for 175, 180, that's a really good price for Nvidia. For me, I have been waiting and I would really like to buy Nvidia. However, I can't say no to this Microsoft pricing. So my focus is mainly on Microsoft and Amazon, that I might have to let this Nvidia price go and not use this opportunity, which is the same thing that happened last year where I didn't get to use this opportunity because I was buying AMD. And the pricing on AMD was like all the way down here on the 2 standard deviations away, that I couldn't say no to getting fully involved in AMD. And that's the issue I have with Microsoft, is that I can't say no to becoming fully involved with Microsoft here. That I might just end up missing another opportunity to get involved with Nvidia because I'm busy. Microsoft is just looking too good. So this is kind of my outlook on the individual stocks and them going into earnings in 2 weeks, 3 weeks, and 2 months from now with Nvidia. But Microsoft and Amazon are the good ones, the ones that we want to be involved with, and we're just holding Facebook. You can buy more of it because obviously this price is still really good, so we can buy more Facebook, and then we're just holding Netflix. Now, the thing that I wanted to talk about with Netflix is that we're getting up back into positive pricing and back into a good outlook and building up on reaching that 125 and reaching that 150 by the end of the year. That's what we're building out right now, is that it's going to want to blow through this $100 mark, and once it does, there's just nothing to stop it. Once we get past this $100 mark and we get past this yellow line here, then it's all blue skies for Netflix. Everything that we acquired, everything that we had bought, breaks through here, and we're immediately going to 112, and then we're just going to return to 125, and then it's business as usual for Netflix. So now's the time to start considering selling calls and trading options. Now, what we want to do, and the whole point and purpose of buying dollar cost averaging every Friday, is because if Netflix is $98, and let's just call it $100 because it's easier to do the math for that. If Netflix is at $100, not everybody has $10,000 to buy 100 shares of Netflix. Not everybody just simply has that to suddenly dump into Netflix. And so instead, we dollar cost average every Friday. And if this lasts, November of last year? So we had all of December, all of January, all of February, and all of March. That's 16 weeks. And whatever you can DCA out of your Friday paychecks into Netflix, it's going to be, say $500 on a Friday times 16 is, what is that? 5,000 plus, let me just pull up the calculator. So we have 500 and we have 16 weeks. That's $8,000. And then when I talk about poor people Netflix, that's NFXL. These are $31 a share, and it's 2 times leverage. So the return and the move back upwards on a total of $8,000 that we got in there over a 16-week period is going to return twice as much as the move on Netflix. And if I'm expecting a move with an average of $100 on Netflix and a move up to 125, and then by the end of the year 150, that's a 25% return and a 50% return. On NFXL, that's a 50% return and a 100% return. What that means on Poor People Netflix is that if you got $8,000 into it, then when we hit 125, you're going to have $12,000. When we hit 150, you're going to have $16,000. So when we go to Netflix, at 125, you're going to have $12,000. You can buy 100 shares. At 150, you're going to have $16,000, so you can buy 110 shares. But you only need 100, so that 10 is just extra. But we bought all of those NFXLs, dollar cost averaging every Friday, to try and get to 100 shares of Netflix. And now, if your average is lower than 100, because we spent a significant time below here, then the potential of reaching 100 shares is higher at that $125 mark, because it's $12,000 to be able to buy 100 shares of Netflix. We have $12,000, but it's $12,500, so you need an extra $500. Whereas if your average was lower, like 95 or 90, just by DCAing in, where my average ended up at like 87.50, I have a much lower average than that $100 average that I'm using just for basic math. But the Poor People's Netflix of NFXL gives you 2 times leverage, gets you twice as much return, and then when it's time to sell it, you can just sell that, take the money, and buy 100 shares of Netflix outright. You can just purely just buy it from that lump sum that you had gotten from NFXL. So now it's time to talk about how to sell options, because we have acquired 100 shares of Netflix. And so the rest of this is going to be working under the assumption that you have at least 100 shares. If you have more than 100 shares, that's great. But for simple math and for simple understanding, I'm going to base it off of 100 shares. So I'm going to base it off of 100 shares at $100. That way the easy math is 10 grand. Now, if we look at the options, which is down here, and I think it looks different on Robinhood, and it looks different on, what's that other one? Webull. It looks different on Webull. It looks different on E-Trade, and was it like Fidelity or something? I'm not really sure. I don't know all of the other trading platforms, but I know that Robinhood is common, and that this looks slightly different on Robinhood. But understanding the basic principle of what this stuff means is what matters. So we own 100 shares, which means that we are allowed to sell what's called a covered call. And we have an average of $100. So if I say I want to sell a call, right now it's 98.66. So the pricing on a $100 call is $3.85. And then we have 100 shares, so that's $385. I'm going to go ahead and say that this is $4 because this is 98 and the $98 strike price is $4.50. So I'm going to just for simple explanation purposes, I'm going to say that at $100, when this is $100 and our average is $100 and we own 100 shares, that this call is going to sell for $4. And this call is for April 17th. It's not this coming Friday, but the next Friday after that. The call above that for April 10th, which is this next Friday expiration, is selling for, if we use the $98 price, it's $2.15. So we're going to pretend like the $100 is $2.15. If I sell this April 10th on today, if the market was open on Friday, if I sell my $100 call based on the idea that I own 100 of these shares and I sell it for $2, it means that if Netflix goes over $100, then whoever bought that option can now buy my shares for $100, regardless of where the stock price goes, they are able to buy my shares for $100. And so for the luxury of being able to have that option, they have to pay me $2, which ends up being $200. So what they're counting on is that Netflix before next Friday goes up to 106 or 110, and then they are able to buy my shares for $100. But the actual stock price is 106, and so then they make $6 off of that transaction, but they had to pay me $2 for the luxury of being able to have that as a choice. Now, what I want to do is I want to just collect this $200. So I want Friday to arrive and for Netflix not to be at $100 so that they don't execute or exercise the option of being able to buy my 100 shares, because if the price next Friday is $98.66, they're not going to buy my shares because they don't want to pay $100 for my shares when they could just pay $98.66 instead. And so that's how the game is played, is that I just want to sell something that's slightly out of reach for $2, which nets me $200 every Friday. Now, if I sell this one, and we're going to still pretend that the price is $100 and that it's sold for $2, I make $200 on Friday. They don't execute the option. I just collect that $200. Then what I do is I take that $200 and I buy more Microsoft. And the Friday after that, I sell another covered call. And when it expires worthless, I take my $200 and I buy more Netflix, or I buy more Microsoft. And then I do it again the next Friday, and the next Friday, and the next Friday, and the next Friday. And that's how, when I said $500 every Friday, that's how it is like passively able to continue to fund the buying of things that are low, is by selling the calls that just give me $200. And then as time goes on, I acquire 100 more shares of Netflix, or 100 more shares of Microsoft, or Facebook, or Amazon, or Apple. And then when I acquire 100 more shares of that, then I can sell 2 calls. So let's pretend now that I have 2 calls of Netflix. Now I can sell one for $200, and I sell another one for $200, and now I'm collecting $400 every Friday. And then every Friday I take that $400 and I buy more Microsoft. And then I keep doing that on the Friday, and I do that on the next Friday, and the next Friday, and the next Friday, and the next Friday. And however many shares I end up with of Microsoft by the end of it turns into 300 or 400 shares, which means that then I can sell 3 or 4 calls at $2. And 3 calls is $600 every Friday. 4 calls is $800 every Friday. And then you just continue to do this. When Microsoft is low or Amazon is low, you just get to buy them. Then when they go up, then you can sell calls off of those that fund whatever the new low thing is, and you continue to buy 100 shares. So then the goal is to never actually sell your 100 shares so that you can continue to use them to sell covered calls that continue to pay you every Friday on expiration, so that you continue to get your $200 or $800 or $1,500 every Friday that is then funding whatever the new thing is low. But if you end up having to sell your 100 shares, then you can't sell calls anymore. So the most important thing is, one, to make money. The second most important thing is, don't sell your 100 shares, because that is what is funding this entire operation. So if we can keep selling calls without executing or without being forced to sell our 100 shares, that would be ideal. Now, sometimes the stock price gets so high, let's say Netflix goes to 150, but it does it immediately after earnings, and it does it like suddenly. Then what we want to do is we want to sell our 100 shares, because by May, let's call it April 27th, the price of 150 is exceedingly high. Like, it's excessively high. How this was immediately a buy down here, that would be immediately a sell. So we want to sell those anyway. We say, okay, you can just take it, because the offset of how much money I would make selling 100 shares at $150 is significantly more than holding those 100 shares and selling the calls and collecting $200 every Friday. If I had it for $100 and I was all the way up here at 150, that is a profit of $5,000. It would take me how many weeks? Where's the calculator? 5,000 divided by 200. It would take me 25 weeks to make that same amount. So the trade-off is I just want that money today. If they're going to give me $5,000 today versus waiting 25 weeks to make that $5,000, then it's worth it to just let those go. Now, where to not let them go is when obviously the profit of selling them isn't as much as what you could just make every week, or maybe the profit is negligible, compared to what you could make every week, but the guarantee of having them means that you can continue to sell calls every week and comfortably just collect $200 or $400 or $600 or $800. So if I can just maintain the 100 shares, then that's what I want to do. But if Netflix skyrockets and goes all the way up here, then of course I'm going to sell them and just take that $5,000. So what happens if we go from 100 up to 106? What do? Well, we have the $100 strike price and we sold it for $2. So we're basically covered as break even at $102 because we're selling it for $100 plus $2. So we're covered to 102. Like that's just like the basic fundamental idea of it. That even if it went to 101, we could still technically let it go because we still profit $100. Now, because we have an average of 100, we would like to probably sell it at least 110, because then we make 10%. Like just off the side, we own 100 shares for $100. If we could sell it for 110, then we just profit 10%. And we say, okay, that's great. If we could sell it for 120, then we just immediately profit 20%, and we say, okay, that's great. Like I will gladly take 20%. But we don't want to really sell it at 102 or 103 because then we're kind of wasting our time, where making 3% doesn't mean anything to me. If I had to put $10,000 into Netflix at $100 per share average, $300 on 10 grand means nothing to me. Yeah, I could just not do that. I could have not spent 6 weeks analyzing and looking at all of this and creating a plan for it to come out 6 months later and make $300 is pointless. That's kind of it, is it's just pointless. So I don't want to do that. I want to sell it for something that is meaningful. And $5,000 is meaningful. 5,000 off of 10,000 in a 12 or a 24 week period is extremely meaningful. So I'll gladly do that. But what I don't want to do is sell it for 102 or 103. So let's say we go to 106 and I don't actually want to sell it. Then what I do is I take my $100 strike price and I do what's called rolling. And I roll it out 1 week to April 17th. That means that I have a contract that says I have sold, or I have offered the opportunity to sell 100 shares at $100, and you're going to pay me $200 for it. But if it doesn't go over 100, then you still have to pay me the 200, but you don't buy my shares. It's basically what it means. And now what I'm offering at 106 is, what is 98 going for? $4.40. So if 98 is $4.40 at April 17th, then we could logically assume that 106 is also going to go for $4.50. So if I take this $100 and I roll that option from 100 up to 106 for something that I sold for $200, and now I'm selling for $450, there's a $250 buffer zone in there of profit that's available. The difference between a $2 and a $4.50 is $2.50. Times 100 is $250. And then the difference between $100 and $106 is $6. That's $600 because there's 100 shares. So I now have an $850 buffer zone. So if the price goes up to $106, then I just roll it. If it goes up and it's going to execute, and I say I don't actually want this to execute, then I roll it. I roll it out to the next week. I pick one that is higher in price a week out so that I don't lose any money. And now I collect $450 minus the $2 that I had sold earlier. So now it's just $2.50 because that's the difference between the two. But then the potential sell price is 106 versus 100, which is a $6 difference times 100 is 6. And so if you speculate the idea of now there's $850 there instead of $200 there, that's the potential profit difference. And then if by April 17th we don't reach $106, which is the new strike that I rolled to and that I sold, then it executes worthless and I collect that $850. If by April 17th it's above 106, then I roll it again. And then I would roll it out to the next week. And the next week, if we're at 110, then I actually don't want to scroll that out, but you kind of get it, where you just continue to roll it out. You continue to roll it to something that is profitable, and you just keep dangling the carrot on the stick just out ahead of what you think is potentially possible. That way, at some point, it will expire worthless, and you will collect that premium. And even if it takes the 24th of April, which is 3 weeks from now, on the 24th, it's going to be $1,200 or $1,400, which then if we divide by 3 or we divide by 4 is still $300 a week, which is the original $200 a week that we were selling it for in the first place. So it doesn't really matter if you have to keep rolling it out, because we just keep dangling the carrot on the stick just out ahead of what we think is potentially possible. But on any of those given weeks, if the strike price is not equal to what the share price is on that expiration Friday, then we let it expire worthless and we suddenly collect that premium for no reason, for no risk. We don't have to sell the shares, we just collect the premium. But if it does come up above the strike price, then we roll it out to the next week. You roll it out, you pick a price that is out of the money, out of the current strike price versus the current stock price, and you pick one that is still offering a good premium that is higher than the one that we had sold previously, so that we're still profitable, and where the difference between the dollar strike price that we had sold previously and the dollar strike price that we're selling that next week on the rollover is also higher, so that we make more money, like $100 versus $106. It's $600, we're still profitable, and we just keep moving it forward until it expires worthless. Then when it does expire worthless, we take those funds and we buy whatever is low, like Microsoft. And so that's kind of the entire idea of selling calls, is that one, you have to acquire 100 shares. And then you want to sell calls that will expire worthless every Friday. But if they don't expire worthless, then you want to roll them out to the next week with a higher expiration date so that they will potentially expire worthless the next week. And as this climbs, you may have to keep rolling it out, or if it climbs and then goes sideways, one of those Fridays it will expire worthless. And when it expires worthless, then you can reset the calendar, restart, and redo it all over again. But if it keeps climbing and it keeps pushing, then we just keep rolling. And you roll it out the next week, and then you roll it out to May 1st, and then you roll it out to May 8th, and then the 15th, and then the 22nd, and then June 18th. And eventually we'll get to a point where by June or July, we're sitting in that $143 range. And you say, well, now I'll just let them go. Like, now I will allow my option to expire, or I will allow my option to execute. I don't want to roll it anymore because now I've made so much money off of this that it's not worth it to continue to hold this. So you just dangle the carrot, keep it out on the stick, keep it in front of the donkey, and let them keep chasing it every single week, and it'll either expire worthless or you roll it out until the price gets to somewhere where we are happy to feed our donkey. And now that we're at $143 on Netflix in July, then we say, okay, donkey, you can have the carrot now. And we allow them to execute the option. We don't roll it out. We just let that Friday come. We let it hit the strike price, and we let them buy them. And then they're saying, haha, I win. And I say, haha, my average was $100. I don't care. I just made 43%, plus all of the premiums along the way. And so that's how selling calls works. Now, once you do sell that call, or once it does execute, then suddenly we have $14,000 because we sold it at $143. So now we have a lump sum of $14,000, plus all of the premiums that we sold along the way. And so then what we do is we look at, let's pretend that it's Microsoft, and so we're going to say MSFU, and that's going to be the poor people Microsoft. It takes $23,000 to buy 100 shares of MSFU. And now we just sold our Netflix. We have a lump sum. It is the middle of July, and we collected $15,000. We can buy, what is that? 15,000 divided by 2350. That's not how that works. 15,000 divided by 2350. We can buy 6 collections of 100 shares of MSFU. So then we say it's the middle of July, which means we're looking at this October option. We have a lump sum of 6 full 100 sets of shares that we could potentially buy on MSFU. And we are looking at a $21 low. So then what we would do is we would come to the put side and we would sell a put. We would sell a put for $21 at $2.40. A put is 100 shares. It is then the offering that we would be the ones who would have to buy 100 shares if it drops to $21 or below. Now, I would be more than happy to buy 100 shares if it dropped to 21 or below, because I'd be more than happy to buy it now. Like I'm buying it now already. So if I'm buying it now already, I would be happy to buy 100 shares by force. If they made me buy 100 shares, I would say thank you. I was going to do that anyway, but you had to pay me $2.40 for something I was going to do anyway. And not only are you going to pay me $2.40, I am able to buy 6 of those. And so now I collect $1,440 every Friday. Of these dates will get more once we were magically in July, but this is actually monthly. So I would collect $1,440 at the end of the month just for offering my potential to buy MSFU at $21. Just for offering it, just for entertaining the idea of it, I can sell a put. And they have to pay me $1,440 before we even begin to acquire the shares. And so then, if then that Friday they don't actually get to 21, the option isn't executed, and I'm not forced to buy 600 shares of MSFU, I still collect the $1,440. I take that $1,440, I buy MSFU because I was going to do it anyway, and then I sell 6 more puts and wait for the end of the month for $1,440 to come to me again and expire worthless. And then you just repeat it in the opposite direction. So instead of selling calls, you take that lump sum and you sell puts. And then we sell puts and we sell puts and we sell puts until we acquire or are forced to buy them, or until Microsoft comes back up. And then whatever shares that we had acquired during that time, when Microsoft comes back up, we start selling calls. And we just rinse and repeat. Whatever's low, we sell puts on. Whatever's high, we sell calls on. But now that everybody, mostly everybody, has 100 shares of Netflix, we can start doing this. If everybody has 100 shares of Netflix or everybody has 100 shares of Meta, you can start selling calls. Meta, I wouldn't do it until we get at least back up to 675. You can sell a call. And on Netflix, you can just push the carrot out. The difference between Meta and Netflix is the same problem we had with Netflix when we started buying them 24 weeks ago. It's that nobody's selling any of these for any amount of value. Now they're at least $2. But at the time when it first came down, even at this same price, even at this same $98 price, the sentiment and the amount somebody was willing to pay for this was nothing. They were like 10 cents, 20 cents, 30 cents. It wasn't even worth it to entertain or waste any time with it because they had no value. But now that Netflix is out of its like doom and gloom dropping phase, and people are starting to wake up and feel good about Netflix and talk good about it on the news, options are starting to gain value, and so now we can start selling calls. But that's sort of how it works, and I would say just like experiment with it and sell the 100 calls, like the 103, no, not the 103. That's not a good price. I don't know. Yeah, the 103 for next Friday. Look for the $2 one, and then just look to push the rolling out a week and roll it out a week and roll it out a week, and just kind of move and flow with it as it goes, and just keep dangling the stick out. It was CoreWeave. CoreWeave is the same thing. Where somebody had said they had an average of $87. You can look at CoreWeave here and see that it's kind of like bonking itself off of this $95 range. So if you can find a Friday option that has like a decent price and the break-even point is above $95, then you can feel pretty good about that it'll either expire worthless or that you can roll it over and continue to roll it over and keep dangling the stick. So if we look at the pricing for CoreWeave, we have $86 at $4 takes us to $90. $90 is roughly, in there. It's right in this region. Let me just draw a line there. Right there. So if on the chart this line looks slightly out of reach, I don't think it's slightly out of reach. I would feel better at 95 just to try and keep it out of reach and keep dangling the stick. But if 86 is selling for $4 and 86 is $4 more than the current price, then we can assume that when it does get to 86, that the price that is $4 above that will also have a $4 premium price attached to it. So if you see this at like $86, then that means that the $90 call is probably selling for $4. And that means that $90 plus $4 is $94, and you're almost at that threshold of 95 that I was looking for. So realistically, you could start selling calls probably at $87 or $88 and feel good about it. Because if you sell calls when the price is at $87, then you'll be able to sell calls for like $92. And then the $92 call will sell for about $4, which will put the price at $96, which is slightly above the $95, which means it's likely to expire worthless, or that you'll profit on it. And you can just keep dangling the stick and chasing the carrot out and out and out and just roll it over every week. And so that's kind of how it would work with CoreWeave, is if you see this at, say, $88, then you can sell a $92 call, and that $92 call will sell for $4, which means that your break-even price is $96, and you just keep it out there. And if it doesn't get to $92, then it expires worthless, and you collect the $400. If it does get to 92 and you don't want to sell your 100 shares, then roll it out to the next week. If it's at $92 and you roll it out to the next week, you're probably looking at a $96 call being sold for $4, which puts you all the way out at $100 on CoreWeave. And then that's, you can just see how it stacks and how you just dangle the carrot. And then eventually, if you do that with CoreWeave and you do it to where it tracks sideways like it has been for, how many is this? Since November. Almost like full sideways action here. If it tracks sideways, you can collect that $400 premium every Friday. But if it does move up, then you can just roll it, and you roll it, and you roll it, and you roll it, all the way until you get to $144 on CoreWeave, and then you say, I don't need to roll this anymore. I had an average of $87. You're telling me I can sell this for $145 today. I'll gladly do that. It's very high on the chart. It's way up here, and it's like 100. It's like a 40 or 50% return, and you say thank you, show me what's next. And so that's how you would approach CoreWeave or Netflix, or how you would approach selling calls, and how to dangle the stick and keep the donkey chasing it. And then eventually you feed the donkey. You just say, okay, donkey, here's your carrot. It is now July 13th of 2026, and CoreWeave is sitting at $147, and you feed the donkey. You say, you don't have to chase this stick anymore. I will gladly let these calls go, collect the final premium, and collect all of my percentage gains from the 100 shares that I had bought back here, because I was the person that spent money every Friday to acquire these when everybody said CoreWeave was bad. Now, I still do say CoreWeave is bad. I'm not advocating for CoreWeave, but I know that you guys own CoreWeave, so I'm just talking about it from your perspective. I'm not buying this. Anybody else watching this video who thinks that I'm saying buy CoreWeave, don't. I'm not for this or about this at all. It was just an example for some of the guys who watch the video that I know own CoreWeave. So it was purely for example purposes and not to actually buy CoreWeave. I do need to make that known. But that is an example, and that's it. So that's how I would sell calls, and that's how I would sell puts, and that's how I would navigate all the ups and downs, and what the future plans are, and how I fund things like buying Meta, buying Microsoft, buying Amazon every Friday. It's from Friday expirations of calls. Every Friday that it expires, I collect my premiums, and I then turn that money into more shares of something else and continue to grow 100 shares at a time. 100 of this and 100 of that, or 50 of this, or 25 of this, and always slowly growing all of these all together so that I can sell calls off of all of them and continue to dangle the carrot out and out and out, and continue to fund this so that it continues to get bigger and bigger, so that I can sell more calls and more calls and more calls until I'm selling 10 or 15 calls a week at $400. And then you're making $5,000 every week, or you're making $10,000 every week. It was from basically from nothing, from buying Netflix every Friday for $200 or $400 from your own paycheck until you got to 100 shares, and that's step one. And then step 50 is now you have 100 shares of all of these. That's like the ultimate goal, is to own 100 shares of Tesla and 100 of Nvidia and Netflix and Microsoft and all of them. And the longer they stay down, while something else like Apple was up and you're able to sell calls off of Apple because it was up here, you sell calls to Apple, you sell calls of Google, and Google funds all of the Microsoft, and Google funds all of the Meta, and Google funds all of the Amazon, and it just funds it week to week to week. And then when somebody's having a good month or having a good quarter, and they're all the way up here, and you're selling calls off of it, then they're funding whoever the new loser is. And so when the new loser pops up on this next earnings, then you say, okay, well, I own 100 of Netflix. I own 100 of Facebook. I own 100 of Microsoft, and I own 100 of Amazon. And 3 out of the 4 are doing really well. I can sell calls off of them. I can keep dangling the stick, and I can sell those calls for $200 every Friday. there are 3 of them. That's $600 every Friday, and now that is funneling whoever is the new loser that I can buy $600 worth of whatever stock it is on that Friday. And yeah, that's how it works. That's really it.